Keep it basic, keep it introductory level, but hopefully it would help you to think about cross-border payments and transactions and the future of money and future of transactions in that sense. Just a brief description of my background. I'm working as a data analyst and research associate at Cambridge Center for Alternative Finance. We do a lot of research on DeFi, fintech, regulations. Sometimes we do market industry research as well. Besides Cambridge, I also own a consulting agency where we work with startup and early stage projects in blockchain and AI industry, and we basically help them to define their strategy, help to package it, and communicate to investors and end users. So not to go too technical, but generally how does traditional transactions cross-border work? By that I mean usually through the bank. For example, you have a bank app, or you go directly to your bank and you send in money to the different account in a different currency in a different country. This, I don't like this diagram as much as this one, maybe, even though this one may seem more complicated. So basically, you can see that the process is not linear and there are a lot of intermediaries involved. Besides you and the receiver and banks, your recipient, usually we see correspondent banks in between, or sometimes several correspondent banks, and on top of that payment systems. And I like this diagram because you can see little icons. The red one is fees. The blue message is anytime when there is like some sort of communication happening between parties. And there is this purple QIC, know your customer, regulatory compliance checks. So what does it mean to you, even if you know nothing about correspondent banking, cross-border transfers, and everything? What is immediately, what is your immediate reaction from seeing this system? First of all, you see at least 5 points when the fees are collected, which means that the traditional system would be quite costly. Now you see 3 moments when there are message icons, meaning that the traditional system would take a long time, because all the communication, all settlement takes time, and on top of that, they hold risk for the banks and for the senders and recipients. And then you see 4 times QIC in anti-money laundering checks, which means again time and bureaucracy for you as a user of the service as well, to go through verification of your identity, of your previous records, and so on, over and over again. So that system seemed to be outdated, or at least there is obvious ways how it can be improved, and there is enough discussion about how blockchain can improve it. And here on this diagram we see how does it work with stable coins, DeFi transaction, which can or cannot happen across borders, which is actually interesting because basically The only difference would be the exchange of currencies. In this example, you see, first of all, USDC, this is stablecoin issued by company Circle, but for USD, fiat on-ramp. Then we see exchange of USDC to Euro Circle, an example how it can be done using different stablecoins and currencies, but again, it doesn't have to. Then we send these tokenized euros, stable coins of euros, to the receiver. Receiver converts stable coins into fiat and get the money to bank account that they have or whatever they use. So that's how it is done. And honestly, in my experience, it doesn't even have to be receiver's wallet. So here we see two wallets involved in the transaction. But for example, if you deal with the person who is not crypto native and doesn't have a wallet or scared about all of that, you basically can buy stable coins, go through on-ramp mechanism of converting one form of money into another, and then doing off-ramp immediately using the bank details of the person you want to send money. So besides obvious advantages of less parties involved in the transaction, less messaging, less fees because there are less parties involved, what are other advantages of this system? Here it might be a bit new terminology for you. I don't know if it is or not, but first of all, within financial industry, there are always concerns about so-called settlement risk. What is settlement risk or settlement risk exposure? This is the situation when, speaking in very simple terms, one bank promised another some amount of money and failed to deliver or failed to deliver it in time. That creates situations when the promises don't match the balances, and it creates basically crisis situations or things very close to crises, and then it can lead to massive bank run or other reactions that would potentially can collapse a lot of other players in the financial space. Then additional thing is price discovery. I'm not sure if you aware of the term. It's usually written AMM, automated market maker. That's the technology, that's the algorithm behind any DeFi or almost any DeFi platform, which is the calculation and stabilization of liquidity pools behind protocols, behind platforms that calculate and define the current, in this situation, exchange rate, right? How do we know how much stable coins, USD stable coins, we need to buy stable coins of euro? That kind of the moment is volatile, and it is the different mechanism used, but blockchain technology was seen as more advanced than what is used right now within financial industry, because all the transactions and all the information about the prices are available almost right here, right now. I mean, there is usually a tiny lag, but still, it's much more transparent and much more information is available and aggregated than in traditional finance. So potentially, and I'll show you, it can improve price discovery, and the prices that exchange tells you will be more accurate than you know, other mechanisms would choose. And the last advantage is so-called witching hours. If you think that it's about witchcraft, I have to disappoint you. It's not really. Um, there are different ways how people use witching hours in finance. Within the cross-border transfers, we usually talk about witching hours as a period after all the centralized exchanges are closed, usually specifically at New York, London exchanges. But to give you a simple example, Saturday and Sunday are usually the days when there is no trade, and so no activity can be done. Where obviously in blockchain, in DeFi, thanks to smart contracts, thanks to the architecture of those platforms in general, it is possible. And that can be an additional benefit for certain parties, businesses, individuals, and so on. So this is a great comparison of traditional exchanges and DeFi. And basically, we can see that on-chain or DeFi exchanges basically kind of better in most of these criteria, right? So that only supports the argument that they should be used. Some terminology here might be confusing for you, but feel free to dive in. It's a big topic. Like, for example, payment versus payment principle is idea that no amount of money, no money can be transferred as unless it is guaranteed that these payments are transferred, which in reality it should be done in traditional finance too, but there is no way to actually guarantee it or freeze it and so on, where blockchain just by design would cancel any transaction unless the payment was successful. So but I'll leave it for your in-depth learning. But I was mentioning, for example, beaching hours, right? This an interesting graph because it shows in the shaded zones of the graph moments when the traditional exchanges were not operating, but the data of the volume of pair traded in Uniswap is showing that there is still a demand and people still would like to trade during Saturday, Sunday, up to Monday. And again, DeFi can cover that demand easily. Then I talked about price discovery. This two line charts that compare Euro and US dollar exchange on the traditional exchanges with, I believe it's also Uniswap, stablecoin of Euro and stablecoin of USDC issued by Circle and their prices. And you can see in some moments squares, especially in November, there is a big one, and it just shows that even though in general prices for the pair was more or less the same, there were certain moments in certain days when on-chain trades were better and more efficient in terms of determining the price. and this was not part of any papers. That was like my personal research in the topic. I tried to understand how many steps an end user, not from the uh, bank or payment system side, or DeFi protocol side, but from the end user, how many steps do we usually go through, or at least see and interact with? And as you can see, a lot of steps. Of course, stablecoins, DeFi don't eliminate all of them, but still seems that there is an opportunity for better, easier transactions, and again, they seem definitely cheaper. Okay. This is a calculation of approximate kind of benchmarks. How much would it cost to send money using DeFi? And we see that it's generally not more than 2%. That's basically my personal experience too. And then based on these calculations and calculations from World Bank and World Bank data on remittances, we see that again, DeFi is definitely cheaper, and there is also an opportunity to reduce it even more, if you use the right providers, and if you pick the right exchanges and everything. And banks, compared to that, definitely lose the game. So what are still concerns, and why we don't see DeFi as #1 solution for cross-border transfers? Well, I mean, I listed 6 reasons, but there are definitely more than that. Regulation, is, UK is a great example with very crypto-skeptic regulation, and there are always strange feelings about crypto in general. A bit harder to do QIC. There are no decentralized identities, and basically parties run into same problems of verification that banks do, at least in the moment of on-ramp, off-ramp, how to say, money withdrawal, or money input. And then UX, again, not everybody has a wallet, and not everybody knows how to do it. A lot of technical terminology is in DeFi that scares out wide shares of population, and kind of ruins the pace of adoption. Security is a big issue, because especially if you deal with wallets, if you shared your wallet information somewhere where you were not supposed to, or if you made a mistake in the wallet address, that kind of you lose everything. And that's there are enough of talks about how to prevent that, but it's very easy to make mistakes, and so basically, again, not everybody potentially can do that. Fiat and crypto conversion is always tricky, and again, there might be dependency on payment providers, and if they fail, or if they have any issues with the DeFi, or it doesn't have to be even DeFi, it can be centralized exchange like Coinbase or Binance. if they fail to provide the services, or there is regulation that kind of against that exchange, then the whole system kind of collapses. And scalability, but that's also typical problem with all blockchains. How can you make sure that blockchains can handle all the demand for transactions and grow further?